Okay, so I think this is a good time to make an update video. I'll just talk about what happened. So I've called off the call option experiment because it has completely failed, and I think maybe I'll show. Well, the point. Okay, so I can't find it now, but the point is that it has completely failed. So I managed to sell one of the call options. I sold the CNQ call option for $129, but all of the other call options, I think that I paid more for the call option than the market value. So I could lose money on all of the other 14 call options. So what I'm doing now is so what I did is I'm selling them back for the same price that I bought them for, and I'm expecting to lose money on all 14 of the call options, because the price is much lower than the market price is much lower than what I paid for. So the good news is that I did something else and made back $400. So this is what I should have done from the beginning. But I didn't, and I can't go back in time, so there's nothing I can do about it. So I'll explain what I did, and I just put the orders in. Obviously, the stock market is closed now. But I should make $400. So what I did, oh shoot. Anyway, so what I did is I bought 400 shares of a BTO. So because I looked at the graph, and it's gone down, like in the past 6 months it went down, but I think overall I think it's safe in the long run. I expect it to increase in price, and it's a stock, so it's never going to expire. So I think my money is safe here. So I have so I'm buying 400 shares of BTO, and then right after that I'm selling 4 call option contracts for BTO. So the premium is $100 per contract. So then I automatically make $400 from selling the 4 call option contracts. And then the strike price on the contract is $5. So whoever buys and this is market price. The market price for one contract is $100, and the market price for one share is $4.50. So the strike price on the contract is $5. So what would happen if someone decided to exercise the contract is that they would buy my BTO shares for $5, even though I paid $4.50. So I would make $50 per 100 shares, so I would make $200. So yeah, so $400 from the premium, and then $200 if they force me to sell my share. So either I make $600 if that happens, or the other possibility is they never choose to buy my shares. So then I still keep the $400 in premium because I sold the contracts. And then nothing else happens. I get to keep my 400 shares of BTO, which I have every reason to assume will keep increasing in price in the long run, and they're stock shares, so they're never going to expire. So I think I could hold on to them for a year, 5 years, and it'll keep increasing in price. Because if I look at the PE ratio is low, and it pays a dividend yield, so it is a very good stock. And if I look at the income is good. It's good. It's not always going up, but I think it's fairly stable. And then the balance sheet is stable. It's stable on average. It's not. I think the balance sheet is growing. It's definitely growing because the assets are growing and the liabilities are falling. So I think this is a good company overall. So, but obviously, I bought it because the price is cheap. So yeah, I made at least $400 back, maybe $600 if they decide to exercise the call option contracts. At least $400, because I think in the long run the stock is going to grow. So then I'll make money from the capital appreciation, and I'll just explain how to calculate the price of an option contract. So for example, for BTO, so I bought for 2026 expiry. I sold for 2026 expiry. So I sold 4 contracts that expire in 2026. $5 strike price. And so per contract I make $106. So it's over $400 to sell 4 of them. So that is what I did. And so I used this same calculator. So this is called the I think it uses the Black-Scholes equation, which calculates the value of an option contract. So it can be a call option or a put option, and then the expiry, the strike price, the price of the stock right now, and the strike price of the contract, how many days until expiry, and then the risk-free interest rate. So that depends on, so that is the government bond interest rate, and the volatility, so that depends on the historical price of the stock, and then the dividend yield is just the dividend yield of the stock. So what I did was I used this to calculate how much the theoretical price of my 15 call options, and then I realized that for CNQ is the only call option where the theoretical price is higher than the price that I paid to buy the call option. So I sold CNQ for market price, and then the other ones, since the theoretical price is much lower than what I paid for it, I'm trying to sell it back for the same price that I paid for it. I think it's unlikely that anybody will buy any of those 14 call options from me, because I'm selling them very overpriced. But if I'm very, very lucky, and then the stock market is very good for the next month, then it's possible that I could sell at least one of them, at least some of them back for the same price that I bought them for. But it's very, very unlikely, so I think that I lost money on those 14 call options. I don't expect to make money because I think the theoretical price is accurate. So if the theoretical price is lower than what I paid for, much lower, then I don't think there's anything I can do unless I'm very, very lucky and the market is very, very good. But obviously I don't expect that to happen, so there's nothing I can do about that, because what's already happened has happened. So so my advice to anybody is don't ever go long on a call option. Never buy a call option. Always sell a call option. So how I made the $400 is I bought the stock and I sold the call option, and this strategy is called the covered call strategy. So for every 100 shares of stock, I sell one call option. So then if I calculate everything correctly, and there's only two possible situations: either the contract buyer forces me to sell my shares to them, or they never do that. So those are the only two possibilities. If in both possibilities I make money, then I'm guaranteed to make money, because those are the only two possibilities. So my advice, after being in the stock market for a week now, is only ever do something if you know that, and if you know every possible outcome, and in every possible outcome you are guaranteed to make money. If that is not the case, then don't do it, because then it's just gambling, and it is possible that you could lose most or even all of your money. So this is the lesson that I learned, and I think that anybody watching my video should follow my advice, because I don't want anybody to make the same mistake that I made, because I thought I could make a lot of money, but I had no guarantee. So obviously it's no surprise, because there was no So anyways, I didn't really plan this video ahead. It's sort of just a partly a lesson on just how to invest in stocks and options, and also how not to invest in stocks and options. And I think I'll continue making videos. So this is going to be a series of videos that I will continue to make, and sort of just my investment adventures. And I don't know if I'll make a lot of money or not. Obviously, I'm hoping that maybe someday I'll become rich. But I think I will make a video, probably not every day, but maybe, every few days, probably at least once a week. So yeah, I didn't really plan this video ahead, so it's not very organized. So anyways, I have said everything, so I'm going to end this video here.